Hello, we are gathered to talk about Chapter 7. Chapter 7, Accounting Information Systems. Really, we're just talking about special journals. So I'm just going to go over, I'm not going through the whole note you guys have read and taken notes already. I'm just going to kind of go over the general idea of what we're talking about here. So you know what a general ledger is already, a controlling account. Right, that's the main ledger that has all the main information in it. The subsidiary ledgers are all ones that branch off from the controlling account, and they are basically specific to a particular customer or some other title or something like that. So that's what it's showing on this chart. Basically, of your general ledger, all cash things stay there. Accounts receivable can be broken into customer accounts. I mean, this stuff makes sense, especially in the computerized age for accounting. Same thing with accounts payable, right? You pay different bills as a company, and so you want to keep the separate companies that you pay a separate account, so you can look up things specific to a certain bill or a certain expense or whatever it is. So you use subsidiary ledgers, right? Okay. Yeah. So this is just basically going through, why do they do it? Really, just get stuff out of the ledger, right? And then you can put it all in one spot, and then you can look at the big picture and find errors, find patterns, find all those kinds of things in one spot. Okay, these are the ones that we deal with: sales journal, purchase journal, cash receipts journal, and the cash payments journal. And those are the type of transactions. We'll look through that. So first one, the sales journal. Okay, so this is where you are just recording sales. You can see that the information given on this particular journal, right? So it's got a place for either your accounts receivable, right? So that's if you make a sale that's on account, or if it's sales credit, that is your revenue stream. Okay, and then depending on that credit, depending on which one you do there, then depends on whether you're doing your cost of goods sold or your merchandise inventory, right? So, or both, more like. So, where'd I go? So, sorry, I'm gonna rewind there for a second. This is a sale made that's not a cash transaction. I didn't say that before. Okay, so this is all going to be accounts receivable. So accounts receivable and your sales match because that's the only thing you're dealing with in here. So if you sent, like the first one, for instance, shows that they sold $10,600 worth of goods to the Abbott sisters, right? So it gives the date, gives the account, the invoice number for reference, reference checked, so it's good. And then you've got your amount, and then it does both the subtracting the goods from the merchandise inventory and the cost of goods sold at the same time. So it's just because those entries all match, which is why they're lined up the way they are. Okay. So same thing with any one of these. You can see the Abbott sisters on there twice, and the 3rd and the 21st. So they would go in the same subsidiary ledger. When you looked at it, you'd look at just the Abbott sisters account, for instance, and you'd see these transactions. But this is just to keep this type of sale, so again, a sale on account, separate because they're all the same. All the entries have the same entry into the ledger system, so there's no point in putting them in the individual ledger. Instead, we just can put them all on what's called the sales journal, right? Makes it nice and neat and tidy. Okay. Now, this is only saying, this here is just saying that all the subsidiary ledgers, when you add them together, the accounts receivable ones, they must equal the total of the sum of those must equal the total of the accounts receivable in the general ledger. If they don't, then you've got some kind of problem. Okay, so if you look at it, they've got Abbott Sisters, Babson Company, Carson Brothers, and Deli Company, right? Those are all the different subsidiary ledgers for this particular business. Add them all up, they get $90,230 as their total. Same thing as the accounts receivable in the general ledger, so they know everything's okay. Okay. The next one is the cash receipts. So this is when you do cash business. Okay, so if it's not, the other one is for accounts receivable. This one is for just cash transactions. So here, accounts credited. So this is where somebody's paying off their bill or they're making a cash transaction. So the first one's, for instance, right, that cash is somebody, what do you think they're doing there? Right? What they're doing there is they're depositing into the business, right? So the owner is making a investment. The next one, the seventh, there's no account credited because this is just a straight cash transaction out of, like, say, a store or something. So someone came in, they bought $1,900 worth of goods. So you've got a $1,900 credit to your sales because that's your revenue. And then you've got the cost of goods sold and the inventory, which are the same number, is going to be $1,240. So that's your straight transaction of a cash transaction in the store. Then we got the Abbott sisters again. Now, this one would probably be them. Remember the last transaction they were doing on May 3rd, they purchased things on account. Well, this is May 10th. This is them paying that $10,600 bill, right, as you can see. Okay, so same things. When you get your reference numbers, it could reference, like a piece of paper or a transaction code or something like that. And the other ones, the checks are going to a specific account, a subsidiary account. And then the cash transactions might have a sales receipt, but they don't necessarily have anything there. Okay, so all these pretty straightforward. Your notes payable, so that's an amount that is paid later, or one that you're paying for, or someone's paying for. Basically, the promise to pay kind of thing. But again, all of these cash receipts, so this is again just cash business. So people are coming into the store and just buying straight cash, like on the 7th or 12th. Or the other ones, various things that involve cash transactions. They're paying their bill from their accounts receivable, or they are investing in the business or paying a debt or something like that. Okay. And again, whoop, too far. So again, you've got to have, this is again just pointing out that your totals must balance. So you've got your accounts receivable equals the total of the subsidiary ledger. That has to be equal. And then again, on your general ledger, your debits and credits, they must also be equal. So that means that your notes payable there, your capital, and your merchandise inventory and the sales together all match the debits, the cash, accounts receivable, and cost of goods sold. Okay. Now the purchase journal. This is where you are purchasing. You're purchasing supplies for the business. So this one is just, again, so it's the date, where you're getting it from, what are the terms of the deal, and then basically that is your merchandise inventory and your accounts payable. So the accounts payable obviously is the bill you have to pay, and the merchandise is how much it's worth to you, which would be the same number because the merchandise inventory is based on the amount you paid to put it into your store to begin with. Okay, so pretty straightforward. All of those ones are different places, but you've got, obviously, they've got 3 suppliers here, like Eaton and Howe and Faber and Son, whatever. All the terms in this case are net 20, so remember that you have to pay the full amount within 20 days. And then you've got various totals because they bought various totals of whatever it is we're talking about. Again, that total at the bottom has to be equivalent, as they show right here. Your merchandise inventory, the general ledger, has to match the subsidiary ledger total. Okay, so that always has to match, otherwise you're going to have a problem, or you do have a problem. And then the last one is the cash payments journal. The cash payments journal is where you are paying, so the business is paying off its bills with transactions that don't involve anything but cash. So cash, of course, could be cash transactions like a check, but in today's world, we're talking about like online payments and stuff like that. Things that are paid immediately and not paid at a later time. These are the bills that they are paying at that exact time or whatever. Okay, so in this case, we've got Again, we got the date, we got the check number, who you're paying, and then the cash is always filled out because it's the cash payments journal. And then what are you paying, right? So your inventory, merchandise inventory is one possibility. And so that one would be, so if you look at Canpar, for instance, that one's probably shipping. So shipping costs to get your inventory in. So these could be freight costs. If you're looking at the other ones, again, you got Eaton Howe, Faber & Son, Jasper Manufacturing. Those are paying off those bills, those net 20 bills. So if you look back, you'd probably see the same totals. And it just breaks it down into, a basic transaction. You see the top one there is slightly different, being the prepaid insurance. Okay, so just again, so like getting a fixed asset in or a prepaid asset on board. And then the last one there is how the drawings would do. So the drawings, as you notice, go into the cash payments journal. Before we had seen the investment of money. This is the taking out for private use, the funds for private use. So again, all in one area makes it much neater, keeps it away from being in the general journal. We also, or the general ledgers, we also, again, we have to have these things have to be balanced, right? So you've got your subsidiary ledgers, and they must, in this case, we're talking about the accounts payable, they must equal the same. Otherwise, you have a problem, and you'd have to look for that particular error. Okay, don't think there's anything to go on here. This is showing what is eliminating, right? So a typical journal entry, for instance, where you'd have so this is just paying your accounts payable for merchandise inventory, just showing that where you would put those instead of putting them into the general journal, how those would look, in a regular transaction, right? And then, those are your things. So hopefully that's pretty straightforward, but that is the idea of the special journals, is to declutter your ledgers, make things all in one spot, and it's much faster to fill out as well when you go and do those. So yeah, that is your special journals. Hope you feel special learning about them. Alrighty, bye bye.